On and get some fundamental conversation going. Mukul Kochhar, the head equities at Investec Capital, is joining in now. Mukul, good morning. Thank you so much for joining in. You know, we have seen earnings downgrades in past couple of quarters. How long before we see a pause to that? What kind of growth are you expecting for Nifty this time around in FY26? And this is happening in a backdrop where we are also seeing rate cuts. So what do you make of that?
Yeah, broadly, if you look at the next 2 years and the next year also, we are expecting Nifty and BSE500 to do roughly double digit, close to 10% sales growth. Net, we expect earnings to be 1 or 2% here or there of that. What you need to sort of take into account is that over the last 10 years, inflation in India has averaged roughly 5%. This inflation number is down below 3% today. So, of course, with lower inflation, you will have some impact on sales and earnings growth. It's natural, very natural to expect that. But the offsetting feature of that is that interest rates also are down because of lower inflation. And also another factor is that demand of money from the government itself is down. They've been consolidating their fiscal. So net, while adjusted for inflation, sales growth is actually the same or higher than the last 10 years. Interest rates are lower. Yeah. So this is something that's very important that investors should keep in mind. A lower nominal inflation, lower interest rates naturally imply that returns from markets will be lower, but adjusted for inflation, we think that the market will still give you reasonable returns. Overall returns should be in line with sales and earnings growth, 10 to 12%. Given that interest rates are declining and deposit rates that clients get, which is the opportunity cost of capital, will also be lower. We think the market's actually priced for fairly reasonable return, and investors should be actually investing today.
Mukul, I remember from our earlier conversations, you'd once spoken about how you're overweight financials, particularly large private sector banks. Was Axis Bank one of the companies that you liked? And what have you made of the negative surprise, this big jump in their provisions, the technical provisions? I mean, how should investors read this? Because the stock is down today, even if you don't own it or you're not recommended it. But tell us the thinking behind this as an investor.
So we are restricted from talking about individual stocks, but I'll give you some idea. Broadly, we expect the asset quality cycle in the banking sector to get better. And that is because bank balance sheets are in an exceptional space, and we believe that unsecured stress that had built up in the system should also get better. In that, we are positioning some of the cheaper banks, which have not had a good run so far, as an investment case. That given that your, overall environment is getting better, these some of the cheaper banks should outperform. Now, what happens in that is you do get quarterly sort of, aberrations here and there. In some banks, naturally, we weren't expecting a surprise, but we did get one. But this is also a valuation call where, you should see that some banks are trading, or the larger banks, maybe trading at a low enough valuation given where we think the sustainable ROA is going to be. So in the large banks, while we have some consistent compounders, on one side, and on some of them, we are taking a little bit more aggressive call based on valuation.
Mukul, good morning. Thank you for joining in. The wires and cable space is been in the spotlight after Polycab's results yesterday. Unlike the paints segment where competition has led to a bit of a valuation derating for the incumbents, here the incumbents are continuing to defy expectations and continuing to post strong numbers, as was evident from Polycab yesterday. Where do you see yourself in this space? Do you still continue to find value despite the increasing competition, or do you believe that the stocks are a little stretched as of now and you would wait for a better entry point?
So wires and cables, is a sector that's positioned very well for the infrastructure cycle. Specifically the power cycle in that infrastructure cycle. Even if you look at the internals of what the companies report, the strength actually comes from the cables business, yeah, which is heavily levered to the infrastructure cycle. The second part is even on the wire side, as electrification takes place, given that electricity itself is becoming a very sort of compelling proposition versus other sources of energy. As electrification increases, you have more demand for wires as well. But right now, the bigger demand is coming from the cable side, which is related to increasing electrification, increasing electric infrastructure. That is a trend we expect to continue, yeah, because electricity is used not just for electrification, let's say, of something that's very obvious, which is EV. A lot of wiring and cables is actually used in data centers, which is firmly in the center of what the next 10-year or 15-year theme is going to be, which is data analytics and AI. Yeah, and this is a global trend. We did speak about FTA on your channel in the past. Within wires and cables, we expect exports also to do very well, especially if we sign some reasonable trade treaties.
Take that point. Mukul, while we are talking about some of these newer or bigger themes, renewables, for instance, India is going big on renewables. A lot of these PSU majors are being asked to put capex there. While the US is doing something opposite right now, there has been a sudden change in policy. Do you think renewable as a theme would give as much return to a business as the traditional energy gives? And what would it mean for the investors of these PSU companies, be it the oil and gas majors or power majors?
See, there's a slight bit of nuance there. So first of all, first part is adoption of renewable. Yeah, there's very little doubt that adoption of renewable will be very strong because economics have started working. In the first stage, renewables have been adopted without a storage solution, but the next stage will be when the storage also becomes economical, and overall, time shift of demand can take place. Time shift of supply, sorry, can take place, and that will be another leg for renewable. So we expect from the demand side and supply side, renewable to be a very firm trend because economics is on the side. For returns, from companies, there are many other factors, which is the level of competition that is going on, how companies are bidding for these contracts. And there, the picture is less clear. There could be a, situation of oversupply where returns for the companies involved in the supply chain are less. And there again, you have capital equipment suppliers, EPC suppliers, and power producers. On the power producer side, there's actually sort of, we see a little bit of compression in return, but, that is also acceptable given that what I said before, that interest rates themselves are lower. So power producers should be okay, but the rest of the supply chain will depend upon the level of competition. But renewables is a very, very firm trend globally based on economics.
Well put. Thank you, Mukul, for joining in. Just to quickly address the flashes